Heyo, it's Matty Loans back in the booth. It's December 2024, and who doesn't appreciate a good test of character? If you've seen Indiana Jones and the Last Crusade, you know the film closes with Indy having to make a tough choice. I won't spoil the ending, but the lesson learned is that if adventure doesn't kill you, bad choices will. So, what does Harrison Ford have to do with the mortgage business? Well, if you've been there before, shopping for the right mortgage can feel like a search for the Holy Grail. But a little education can go a long way. And after 20 years in the mortgage game, perhaps I can provide you with some know how you can leverage for your next mortgage, whenever that quest may come. If 2025 is the year for you to begin your home buying crusade, perhaps this video will educate you on an old school and new school program to help you purchase your next home. Like the Carpenter's Cup, real gold's found within. So today, let's go under the hood and compare and contrast two programs, the FHA with the Home Possible. So let's raise a toast to those brave souls staring down the path of home ownership. Here's to choosing wisely. So let's start from square one. A loan program we should have at least heard of, the good old FHA loan. FHA mortgages are insured by the Federal Housing Administration. It's the people's choice for most first time homebuyers. But the reality is that anyone can use the FHA loan as long as it's for their primary residence. The number one reason why first timers start with FHA financing is due to the minimum down payment, which is 3.5%. Since this program protects the lender in the case of default, FHA loans are widely available and can provide you with more flex when it comes to qualifying. Referring to the credit requirements, there is a floor, but that minimum FICO score may depend on your lender. Program minimums state that 500 may be as low as you can go, but that one may be a tough ask of you, as that will require more down payment than the program minimum. Exact scores can vary, perhaps requiring a minimum mid score of 580 for the minimum 3.5% down. Score requirements may vary, also depending on the amount of down payment. So the FHA loan can be a good first choice or a loan of last resort. In comparison to an equal application for conventional financing, the same lender may require a minimum credit score of 620. FHA loans can provide alternatives if you don't check all of the conventional requirements. Keep in mind, the higher your credit scores, the lower your risk profile, which will help lower your interest rate and increase the terms and program options available. It's a myth that in order to buy a home, you need 20% down payment. 20% is a healthy amount of down payment, but just because you have it doesn't mean you need to use all of it. I always encourage buyers to make the most down payment that's safe and reasonable, but also one that minimizes the lowest possible monthly payment. FHA is associated with the ability for the minimum down payment of 3.5% of the sales price. So buying a home for $100,000 would require an initial investment of $3,500. This helps lower the bar to home ownership, but understand down payment can be tip of the iceberg. It's likely you're going to need more than 3.5% to qualify, but the source of down payment is equally as important. Did you know that all of the down payment can come from a gift? Also, there's a little helper called down payment assistance, which can be tapped from your state or local housing authority to give you a boost on the investment required in order to make your home a reality. DPAs, as they call them, can be combined with FHA loans. Expect interest rates on FHA loans to be competitive to their conventional counterparts, but you may even see a better rate on an FHA loan with less down versus a conventional loan with more down payment. This can happen because the government backs these loans. They start with a lower base rate, which in turn helps lower the risk from the lender. Ultimately, your final rate will depend on your complete profile, the amount of down payment, your credit score, the lock period, the state location, sometimes even the county, and loan term, just to name a few. You have to appreciate that FHA loans do not have a prepayment penalty. You can pay off your loan at any time and for any reason. You can buy your home using an FHA loan, then refinance to conventional, or do the opposite. Start with conventional and refinance into an FHA loan. But before you get too excited, it's important to keep stock in a few things. Like all minimum down payment loans, those with less than 20% down payment come with a factor of mortgage insurance. FHA loans are no exception. All FHA loans have mortgage insurance, which protects your lender, not you, in the case of default. I did another vid on MI and the 3 ways to remove it. But what's daunting about mortgage insurance and the FHA is that you get taxed 2 ways on FHA loans. First, you pay an upfront fee at closing, then you pay a monthly premium with your mortgage payment. It's critical to understand that if you plan on putting less than 10% down, you're locked into mortgage insurance on an FHA loan for the life of that loan. It's only when you make at least 10% down payment that you'll pay MIP for the next 11 years, or as long as you have the original FHA loan. After 11 years pass, then it can be removed. Consider there is a max of how much you can possibly borrow through the FHA. Your 3.5% does not give you an unlimited loan request no matter how much money you make. The limit's determined by location, state, and county. Here's an example. Say you're between 2 states, California and Arizona, which is Riverside and La Paz counties, respectively. If you're looking to borrow on the California side, you could borrow more, technically. But if you're on the Arizona side, your FHA loan max is less. Likewise, with the state, you're going to find differences with loan limits based on the county. Loan limits are typically updated each year, and the new amounts will be released soon for 2025. If you're on the bubble, good news, it will likely increase. Peep your FHA loan limit here. So, with a low down payment, wide range of acceptable credit scores, ever increasing loan amounts, why consider any other program? Sometimes it helps to think like a seller. Here's a loan tip. While your lender may welcome your FHA loan with open arms, it's not always the case with sellers in all home types. FHA loans can make sellers a little skittish, especially if the home needs some TLC, as FHA loans have a more stringent appraisal process. FHA appraisals can scrutinize the condition of the property, making it feel like a home inspection almost. The FHA will make sure via the appraisal, not your home inspection, that your home's safe to live in and is habitable. But yes, there are certain requirements the home will need to meet. Homes with defects like cracked tile could be required to be repaired prior to closing. Some of these are obvious, while others hard to predict, like wood to earth contact. Hope you have an eye for a negative grading towards the foundation. Yes, if it's identified, it's likely to be condition of the final value and property approval. Don't forget about big items like electrical wiring, ventilation, mold. It's all game for the property approval. It's hard to repair a home you don't own yet, and the seller may just have to say they're not going to fix it. Without evidence of these material conditions that they've been cured, your loan may not be eligible for FHA financing. For those looking to buy their first condo, sometimes the HOA community itself may not be FHA eligible. In those circumstances, it's out of the seller's hands. So if you want to buy a condo in that particular community, you may need a plan B. That's what FHA loans look like on paper. So now let's show you an example of how they may impact your wallet. This way, you know how to compare. For argument's sake, let's assume a few things. I'm applying for a loan, and here's my setup. I currently rent, but I'm buying a primary residence. I have excellent credit. I have money in a savings account of at least 3.5% down and enough left over for closing costs and prepaids and reserves just in case. I've been working as a carpenter for the past 2 years with over 2 years in the same business and will have an income that's 2.2 times the total debt I'm requesting, existing and new, with the new housing payment. So I've been out shopping with my realtor and found some awesome home in Mars for $100,000. Follow me as I build my monthly payment, first choosing a term. FHA loans come in lengths of 10 to 30 years, but I'm interested in the lowest monthly payment, so I'm going to select a 30-year term. Like all mortgages, shorter the term, lower the rate. A lower rate for a 20 or 15 years is tempting, but it's going to increase my monthly payment. Now, it's possible I could get a lower rate on a 30-year term through an adjustable rate mortgage, but like a high level of predictability, I'm only interested in what a 30-year fixed term looks like. That way I know what my principal and interest payment is going to be. It's going to be fixed for the long term or as long as I keep that loan. Now let's assume market rate of a 30-year fixed is 8%, and that's without paying any points. So voila, we have a base mortgage payment, principal and interest as they call it, but also I need to consider the insurance, taxes, and dues with all minimum down programs. Ditto with the FHA. There's going to be a monthly ad for the mortgage insurance premium that again protects who? The lender, not you. I know, boo, it's a small price to pay to be a homeowner. Now, it's a double thumbs down for FHA because we need to consider that all FHAs have a monthly mortgage insurance premium and then an upfront mortgage insurance premium that is factored in as a closing cost or loan amount increase. The standard rate of mortgage insurance for FHA programs can range between 0.5% to 0.75% of the loan amount for 30-year terms. For 15-year terms, it's going to be lower, from 0.15 to 0.65%. So, what do peeps say? Lower the term and we lower the what? Risk. So, the MIP rate will depend on the loan amount, the down payment, the sales price. If your down is less than 5%, you could end up paying 0.55% per year. A quick calc, take the loan amount and times it by 0.075, then divide it by 12 months, and that's your monthly MIP amount. Now, we're not completely done with your MI factor. Remember that these loans are always subject to MI tax in two ways. Here's the real kicker. Expect 1.75% of the loan amount to be added to your loan or set up as a closing fee. Besides the upfront MIP, there are other closing costs you'll need to be ready to pay on closing day. Closing costs and prepaid expenses or out-of-pocket expenses you're going to need to pay to consummate the purchase. Expect closing costs to be in the form of lender fees, title fees, and some third-party costs. I'm using Fantasy Mortgage for financing, so let's assume the following. Unlike the upfront mortgage insurance premium, these costs have to be paid, either by the buyer or perhaps the seller. The gift maker can pay them, but someone has to do it. You could also take a premium rate and receive a lender credit to offset some of these costs. Then there are prepaid expenses, which include property taxes, your homeowner's insurance, dues, and prepaid interest. Let's also assume the following for these fees. Property taxes on Mars, well, they're not cheap, but we're going to estimate $333 per month, insurance of $222 per month, and let's give some HOA allocation of $11 monthly. Here's an example of how my monthly payment stacks up in the total out of pocket, down payment, closing cost, and prepaids. Here's where the rubber meets the road, the loan summary document. It mirrors a loan estimate and helps clarify the setup, the total out of pocket and monthly payment of the prospective loan. Here, the FHA 30-year fixed. It's a lot of info, but let's define it in 4 quads, starting left, right, then top, bottom, with the first segment, the loan or transaction summary, ID and the sales price, loan amount, and cash to close. To the right, the corresponding payment breakdown. The bottom 2 segments are the closing fees and prepaids. Left is lender and title cost, and right is other fees and prepaids. Back top right to the loan characteristics, you can see it's a 30-year fixed rate FHA loan with an 8% interest rate. Let's translate a 3.5% down payment FHA program into a monthly payment, principal and interest, taxes, insurance, HOA dues, and then the mortgage insurance premium. Based on the sales price of $100,000 and the minimum amount down, this prospective property will cost me around $1,330.51 per month. Is this a fair, good, or great deal? We don't know exactly until we compare, but take into consideration in box 3, there are no points. Still, the lender costs are $1,933. Because this is an FHA loan, there is a funding fee. For this loan, it costs $1,688.75. You can see all but the last 75 cents in the summary section. This is what we regard as the upfront MI fee, either paid as a closing cost or rolled in the loan amount. In this case, rolled in. What we want to impress is how the monthly payments determined by the loan program, the term, the rate, and lender cost. Remember when I said you pay the MI tax twice on FHA? Look back at the payment breakdown and consider that in addition to the upfront 1.75% fee, there is a $44.04 of MI to pay each month. as long as I have this loan. Do you know why? Not bad, but before I commit, I'm going to want to compare this for the best deal. That's a high level overview on what FHA loans entail. But now it's time for Act Two. The FHA is not the only game in town when it comes to low down payment mortgages. There are other formats that rival the structure of FHA loans using conventional financing. Two examples are the Fannie Mae Home Ready loan and the Freddie counterpart, the Home Possible. Both loans are relatively the same program, just share a different investor. Since there are minimal differences between the two, and for interest of time, I'm going to focus on the Home Possible loan. While the FHA loan has been around for 90 years, the Home Possible program is relatively new. It's been out since 2014. Most everyone has heard of FHA, but Home Possible can make a great alternative. The program was created with the low to moderate income borrower based on property location. Like FHA, Home Possible provides expanded terms that include low down payments and as low as 3%. What's noteworthy about the Home Possible loan is that credit scores are not required. Just because you don't have credit scores doesn't mean that you will not have to document your credit worthiness. The downside is that if you don't have credit scores, expect to make at least 5% down payment. As a substitute for a credit report, you'll need some non traditional credit references. You'll need to have to demonstrate timely payments using your insurance, your utilities, perhaps your cell phone service, or other alternatives that are acceptable with the lender outline to show that you can manage expenses. Like the FHA loan, Home Possible is an attractive option due to the loan down payment. Not only does the Home Possible program allow for 3% down payment, there's no upfront mortgage insurance premium or funding fee. This keeps the math simple. It's just your down payment and closing cost come closing day. In addition to their own funds, a borrower can also receive assistance in reaching the minimum 3% down payment on a one unit property from other sources. These include a gift from a person meeting the definition of a related person, funds from a government or non governmental agency like DPA, or maybe employer assistant home ownership programs and affordable second mortgages. In regards to interest rates to the FHA, they may be the same, better, or worse. Lender dependent on the Home Possible loan may price better than a standard conventional loan. There is also a conventional 97% single loan that works like the Home Ready and Home Possible, but the rates for the 97% loan can be higher, interest rates. But there's also a different loan altogether, so it may not come down across the board like everything else. Like all rates, it'll depend on your credit score, your down payment, your term, your lock period, etc. When it comes to prepayment penalties, you don't need to worry about them with the Home Possible. In fact, all conventional loans will not have a prepayment penalty. Pay off early, refinance, it's fine. Refinancing to an FHA loan or any other loan, and it won't impact your payoff. Mortgage insurance is a nuance you're going to have to pay close attention to because that amount of MI will depend on term, your down payment, your credit score. Depending on those parameters, it's very likely the mortgage insurance monthly can be higher with Home Possible relative to an equal FHA loan. However, in comparison to the 97% conventional loan or even a 95% conventional loan, Home Possible mortgage insurance is discounted from the standard 35% MI coverage to the reduced 25% coverage. So it's not likely the lowest MI out there, but certainly not the highest on the market as a total package. But it gives the FHA a run for the money. Unlike FHA loans, the Home Possible loan only comes with monthly mortgage insurance expense. There's no upfront mortgage insurance that you'll have to pay or roll into the loan amount and forced into a higher loan if you can't pay it in full as a fee at closing. Even better, the required term of MI is not predicated on the amount of down payment. Make 3%, 5%, 15% down, and you can eliminate the mortgage insurance automatically once you reach 78% LTV, or borrower requested at the 80%, or terminally once you reach halfway through the amortization. It's a huge advantage not having to factor in the 1.75 cost of the upfront mortgage insurance on FHA loans, because who knows how long you're going to end up keeping that loan or what portion of the upfront FHA mortgage insurance premium will prorate. The benefit to Home Possible is that you minimize your closing costs or you increase your equity. As rates improve over time, you can set yourself up for a proper refinance. You don't have to factor in a refund of the upfront mortgage insurance premium on the FHA loan. And with more equity, likely closer to eliminating mortgage insurance faster. Think if you can lower the interest rate and rate of mortgage insurance at the same time, it's a huge bonus. But let the numbers speak for themselves. So, what's the catch with Home Possible? It appears to have more advantages than disadvantages. Like all lending, there are limitations, and this loan has a big one. With this loan, it's not primarily restricted by state or county, but by the census tract and the local area median income. True, both Home Ready and Home Possible are governed by the conforming loan maximum, which is currently $766,550. In comparison to the FHA loan amount, which is going to be limited to $498,250 in low-cost areas. That appears an advantage for you, but could potentially allow you to borrow more with the Home Possible loan until you realize that the loan requires the borrower to be at 80% or less of the area median income. Even if you lived in some of the high-cost states like Virginia or, say, Maryland, where the area median income can be as high as $160,000 per census tract, this loan will only allow borrowers to qualify at 80% of that respective income. So take your 160 annual income and 80% of it, and that means the total qualifying income for Home Possible in that certain area may not exceed $130,000 per year. The income restriction is going to limit the value of home you can possibly qualify right off the bat, making the reality that you stretch out a loan to $700,000 plus a challenge. If you're going to bring in cosigners, consider that all income will need to be less than the threshold. Cosigners and non-occupant borrowers' income will count towards the 80% income max. Last, it is within the guidelines to qualify on just your base pay. For example, if the area median income is set at $100,000, and we know that 80% of that figure is $80,000, in that example, say you make a base salary of $75,000, but $25,000 annual for bonus for effective $100,000 in potential qualifying per year. Yes, it's a legal move to qualify on your base alone, even though your gross income may be higher than 80% of the area median income. Just like the FHA, the Home Possible loan is exclusively for primary use. No vacation or investment properties are permitted with this program. But it's also good to know that the appraisal requirement will follow the standard format like a conventional loan. There's no need to worry about your appraisal for Home Possible having the same scrutiny of the FHA counterpart. It'll need to be habitable with functional plumbing, electrical, a working stove. So just because it's not FHA doesn't mean it won't have standards. Now we know one more path to the low down loan. Let's dive into some of my numbers on how a Home Possible worked for myself from Fantasy Mortgage. This way I can compare apples to apples with the same lender and see what's a better deal for myself, an old school FHA or the new school Home Possible. And again, just to review my characteristics, I'm buying a primary residence. I have excellent credit. I've got the ability to make the 3% down. And I've got a steady job as a carpenter and will have debt to income less than 45%. I don't have any rental properties and I don't have any need for a cosigner. So let's go back to the drawing board and sample a home of $100,000 sales price on Mars. Since we've used the 30-year fix for FHA, we're going to use the same for Home Possible. Ditto on the fixed rate. Next, I got the cash to make the down payment and closing cost all by myself. On Home Possible, you can use a premium rate to pay for some closing costs or just offset it. But you can't use a credit from the lender for your down payment. So here is how the P&I payment will stack up. The Home Possible loan comes with reduced mortgage insurance, which is 0.25% of the loan amount. We don't have to worry about an upfront mortgage insurance premium because it's not an FHA loan. Since we're dealing with the same property, let's have the same expectation on closing costs to be in the form of lender fees, title fees, and some third-party costs. Again, I'm using Fantasy Mortgage for financing. So let's assume the same rate and even 8%. But in real life, you need to expect there's going to be some slight differences. Let's give the same for property taxes, homeowners insurance, dues, and prepaid interest. And again, property taxes are $333 per month, insurance $222 per month. Instead, HOA dues are $11. So here's how my payment stacks up with possible closing costs. Here are the dollars and cents for a home possible example. This follows the same exact format as the prior FHA loan. To streamline this exercise, all of the closing costs and all the prepaids are going to be exactly the same. The only differences are the program parameters set up based on the minimum down payment and respective mortgage insurance cost. Even the origination fees are left the same. Ditto on interest rate at 8%. This isolates the program differences and impact on closing day and every month thereafter. In reality, expect different costs for origination and interest rates, even with the same lender. Understand with Home Possible, there's no upfront mortgage insurance funding fee, so the loan amount doesn't need to be adjusted or factored of any higher closing cost. So with 3% down plus closing costs and prepaids, here's my monthly payment: principal and interest, taxes, insurance, HOA dues, and yes, monthly mortgage insurance. Based on the sales price of $100,000 and the minimum amount down, this prospective property will cost me about $1326.25 monthly. It's just a little bit lower because the loan amount is less. The out-of-pocket's $575 cheaper, hence the cheaper P&I payment. However, when it comes to the monthly mortgage insurance, it's slightly higher. This illustrates the give and take. Home Possible may be cheaper, but not in every facet. Still, with a slightly higher MI at $4,850, it's still a slightly lower payment, and with no funding fee, a little less complicated. Moving on to a side-by-side comparison, which do you think is a better option for me? So here's one last look of the cash to close and monthly payment with all things being equal, including the origination cost, total lender fees, and the exact same interest rates. Even with my same credit scores, the monthly MI factors dictated by program. And no matter my credit, I'm stuck with the funding fee if I go FHA. Inside looking out, they're very close in numbers, but the program requirements are very different. Choices are always good, but in real life, external forces may limit my options. I can see advantages in both, but the right answer may depend on how long I plan on keeping the home, then how long do I plan on keeping the loan? What if interest rates fall? What if they rise? What happens if home values fall flat or decline? Neither has a prepayment penalty. Both require mortgage insurance, but one has a funding fee. Yes, both have mortgage insurance, but one is slightly higher that may wipe out any potential savings if the interest rate's better. One program, you're required to make a little bit more down payment, but have less equity due to the funding fee. One permits unlimited income, while the other is restricted to 80% of the area median income. One is almost a century old, while one's only a decade. Both are great programs to help you buy with minimum down payments. I guess there's no right or wrong answer. That depends on you, and maybe a different answer for you than it is for me. Hopefully, Triple B provides a unique perspective you can appreciate. If there's a mortgage topic out there you'd like made, please hit me up on the comments or on X at Matty Loans. Thanks for viewing.
You have chosen wisely.